A very good afternoon to all. I'll start off the webinar by providing a brief presentation on the Malaysian economic condition and its outlook for the rest of the year. Next, Dimi. Today, I'll be attempting to answer the question that is probably on everyone's minds recently. Is Malaysia still on track for recovery? So to do that, I'll start off by assessing where the economy is at currently. Then I'll go over the headwinds and risks that the economy is facing and some of the developing trends as well. Then lastly, I'll round up with Malaysia's 2022 outlook. Next. So the lockdown and reopening of the economy are perhaps something all of us here are already very accustomed to over the last 2 years. However, the sort of widespread disruption as well as destruction to the economy is not expected to repeat itself this year, given the Malaysia's high vaccination rate, as well as Malaysia also transitioning to an endemic phase. So the services sector, retail trade in particular, stands to gain the most from the reopening of the economy and lifting of restrictions. So as you can see from the left-hand side chart, retail trade has been on a steep recovery since the middle of last year, which is consistent with the improving labor market conditions and the relaxation of mobility restrictions. So if you use the Google mobility data as a proxy, as shown on the right-hand side chart, which tracks the consumer movements towards points of spending. So we are able to tell that consumption activity have somewhat returned to a pre-pandemic normal as well. So this is in sharp contrast to the subdued condition experienced in the last 2 years. So as more consumers are able to actually head out, consumption spending also made a strong comeback. And the robust momentum seen in the first half is likely to persist as well, given the continued recovery in the labor market condition, as well as household income as well. So this, alongside with the one-off boost that we are also expecting from the minimum wage increase, as well as the EPF withdrawal program, should provide the upliftment needed for the sector's continued expansion for the rest of this year. Next. Moving to the industrial segment, so the manufacturing sector has been a key support to Malaysia's growth throughout the pandemic, so largely through a strong export demand for E&E as well as semiconductor chips. So as depicted by the left-hand side chart, the support from the export-oriented production stayed relatively sustained in the first half of the year, and as such is still a significant contributor to overall manufacturing output so far this year. Besides, we are also seeing additional support from domestic-oriented industries as well, after recovering from its relatively sluggish performance during the pandemic years. As such, the sector's growth this year is expected to be relatively diversified and also more resilient as well. And this broader-based demand recovery is timely, given the emerging risks that we are also seeing from a deceleration in global demand momentum. The global manufacturing PMI has been on a notable downtrend so far this year, indicating a deceleration in global manufacturing activity. That said, one positive observation is that global PMI remain above the neutral threshold of 50, which indicate a continued expansion. So there is still some positive end on that end. Other than that, the concerns towards the disruption to the global value chain coming out from China as well have also eased somewhat. So we can see that China's PMI data have also rebounded after emerging from its lockdown in the first quarter of this year. So the immediate negative spillover to Malaysia is relatively contained for now, although risk of further slowdown also still remains rather prominent. Next. In contrast, the performance of other sectors so far this year has not been as rosy. So for both the agriculture and construction sector, output has been plagued by foreign worker shortages as well as pressure from higher input costs. So until when the labor supply issue is resolved, performance for both sectors will likely remain challenged. Meanwhile, the mining sector has also been facing capacity constraints due to underinvestments in oil production and exploration over the past few years. So while capital expenditure is expected to pick up domestically this year in response to better earnings outlook, it will take some time before this new productive capacity actually comes online. As such, these three sectors will lag relatively behind in terms of economic recovery, at least for 2022. Next. So despite some sector-specific challenges, as mentioned in the previous slide, I think Malaysia overall or generally actually still saw a fairly healthy economic growth in the first quarter of 2022. So the first quarter GDP growth came in at 5%, which is an upside surprise compared to the 3.6% median forecast in the Bloomberg poll. Guided by some of the monthly economic data available as well for the second quarter, I think we are expected to also see GDP growth further accelerate in the second quarter as well. So as a whole, the relatively strong momentum observed actually sets a rather promising path in terms of a more continued recovery looking ahead as we go into the second half this year. Next. So just when we thought this year was supposed to be the year of recovery, but the global economy is again under another threat. So many of the negative risks I think we see among most of the headlines today are interlinked and can be largely traced back to Russia's invasion of Ukraine earlier this year. So the war had not only led to a humanitarian catastrophe, but it has also led to deep regional slowdown as well as substantial negative spillover effects that is actually felt globally. And one of the biggest risks that to a global downturn, or that could actually lead to a global downturn that is also discussed quite prominently recently, is the potential recession in the United States that is actually triggered by an aggressive monetary policy tightening that they are actually undergoing at the moment. So the aggressiveness in the US comes amid the Federal Reserve's attempt to surging inflation, which had been exacerbated by the negative spillover from the war in Ukraine. So as you can see from the left-hand side chart, the Fed had raised its interest rate projection multiple times over the past few quarters, illustrating the increasingly hawkish stance that the Fed has actually taken in response to inflation. So with inflation showing no signs of subsiding, the Fed is currently projecting for another 175 basis point increase through the rest of the year. And this is on top of the 100 basis points already increased so far this year. So the significantly tighter monetary conditions will look to actually pull the brakes on US economic activity moving ahead. Another notable downside risk is also China's aggressive COVID-19 containment policy. China's widespread lockdown earlier this year actually took a toll, quite a substantial toll, I would say, on its export, as you can see from the right-hand side chart. As a result, the global supply chain also took a hit, and things does not actually look so good during that time. However, with the recent lifting of China's lockdown, we have fortunately seen that China's export quickly rebounded, while supply chain pressure also immediately continued to ease. So we are still seeing some positive development on that front. However, another lockdown in China, which is possible, I would say, still has the potential to actually still slow global trade, and which would also in turn affect Malaysia's export performance as well. So that is something to also look out for. Next. So Malaysia is also not spared from the direct spillover effects of this external development, as the spike in global food and commodity prices directly feeds into higher domestic inflationary pressure. So I think most of us who have already felt it, if you refer to just purely from roti canai prices, I think it have went from 150 to some to even 250 as well. So I think even breakfasts are getting more expensive nowadays. And consumers perceive inflation is already higher on that end, and I think most people in the audience can also feel it. And to a certain extent, this will also be reflected in the official headline inflation as well. And RAND is currently projecting overall inflation to actually climb further to 3% this year from 2.5% last year, which much of the increase actually largely driven by higher food prices. And given that food constitute around 30% of the household expenditure, higher food prices will definitely hurt households' budget quite prominently. And well, to a certain extent, if you look on the other end, the price control measures and subsidy will somewhat help to mitigate some of the cost pass-through, but I think consumers will likely still face higher prices this year regardless. And the resultant erosion of purchasing power is expected to hurt consumption demand momentum and weigh on Malaysia's recovery momentum in the second half of this year. Next. Based on our most recent RAND Business Confidence Index survey, it is also evident that businesses are also feeling the pressure from rising global prices. So before I delve into the survey findings, just very briefly, what is this Business Confidence Index, or BCI for short, about? So the BCI is actually a comprehensive survey conducted by RAM on forward-looking business sentiment, as well as topical issues faced by the small and medium business community in Malaysia. So one of the topics that we periodically survey is the challenges faced by businesses. And the most recent survey indicates that rising costs continues to top the list of challenges faced for the second consecutive quarter. And the share of firms citing this challenge actually rose to a high of 83% of firms surveyed in our second quarter survey, which is actually quite high and much higher than the less than 60% share that we saw a year ago. Besides that, we also know that firms are also increasingly concerned about manpower shortages. So the share of firms citing this challenge also climbed to a steep 54% in the second quarter survey compared to 43% in the previous survey. So the resultant wage push pressure as a result of this shortage might have also compounded upon the rising cost pressure faced by businesses as well. Next. That said, I think if we flip on the other end, not all hope is lost. I think firms surveyed in our recent BCI showed a firmer level of optimism towards their prospects over the next 3 months, despite some of the headwinds faced. So the overall index, which is a composite indicator tracking the sentiment of 5 key business aspects, rose to 65 points in our latest survey, as you can see from the chart. So this is higher than the 55.4 points in the previous quarter, while it's also a marked turnaround from the persistent pessimism observed over the last 2 years as well due to the pandemic. So this suggests that firms surveyed expect business activity to actually gather further pace moving ahead as the economy continues to recover. Next, the stronger economic prospects is also something that is also taken note by policymakers. So against this backdrop, we saw Bank Negara engage in successive 25 basis point hikes over the last 2 monetary policy committee meetings, citing the firmer economic recovery while also noting that the excessively accommodative policy setting is no longer required given some of the strong recovery momentum observed. So the improving economy is also evident with the healthy labor market recovery so far. So we saw that unemployment rate actually fell to 3.9% in May, down from an average of 4.6% last year. At the same time, more people are getting employed as well. The number of people employed as a share of working age population rose to a high of 66.8% in May, which also indicates that it has already recovered back to its pre-pandemic levels as well. Nevertheless, I think outlook this year remains tilted to the downside. Further escalation in geopolitical conflicts, deep slowdown in global growth, and as well as possible worsening of supply chain disruption or supply chain conditions, all could actually throw a spanner in the works in terms of Malaysia's ongoing recovery. Next. So this brings me to my last slide on the 2022 outlook. So now to actually answer the question posed at the start of the presentation, is Malaysia still on track for recovery? So I think given the strong momentum observed so far, Malaysia's post-pandemic recovery is definitely well underway, despite some of the challenges and hiccups faced in the first half of the year. However, I think the challenge really comes about whether we can actually sustain this momentum going into the second half, as some of the negative external developments mentioned in the earlier slides starts to be felt more prominently in Malaysia. All said, but then we still believe that 2022 is still likely looking to be the year of recovery for Malaysia. Important to note that we are also coming out from a low base, so recovery is expected to be ongoing this year as well. And much of the recovery will be propelled by strong domestic demand recovery, as well as a sustained export performance, especially in the E&E and semiconductor sector as well. Although some of the performance might be somewhat dampened by the higher domestic inflation, as well as a slight moderation or to a certain extent some moderation in terms of external demand as well. However, I think the recovery is, we are looking likely to post quite a strong recovery for 2022. And our current projection is for Malaysia's GDP growth to stage a firmer recovery of 5.8% in 2022, which is an acceleration from 3.1% in 2021. And this would mean that Malaysia should be on track for its strongest economic growth since the start of the pandemic. Before I end my session, I think I would I thought it will also be interesting to also get a sense or the opinion of everyone in the audience on Malaysia's economic prospect as well. Lee Min, can you help to quickly pull up the poll? So I would like to do a quick poll on what the audience thinks is the biggest risk to Malaysia's economy this year. So I felt that instead of listening to what an economist has to say, maybe the sentiment on the ground or sentiment among the audience will also be a very interesting observation among our attendees today. Once we have sufficient results, can you pull up the result as well? So it appears that I think close to half of our audience today thinks that high inflation is the biggest risk to Malaysia's economic growth this year, and I think I would also agree to that opinion as well. Given that I think high inflation definitely has quite a strong power in terms of dampening the quite a healthy recovery in terms of consumption demand that we saw so far, and I think it is also imperative that we keep inflation under check to ensure that Malaysia is still on track to actually chart a very strong recovery for this year and going into next year as well. And I think that concludes my presentation for today. And I hope that what I have shared, along with some of the insights from the quick poll that's done before this, provided you with some useful insight on Malaysia's outlook for this year. Back to you, Lee Min. Thank you.
Very good afternoon, everyone. Today, I'll be presenting RAM's outlook on the banking sector, where I'll be walking you through on some of our expectations for the Malaysian banks in the coming year. I would like to just start off today by saying that we are maintaining the stable outlook on the banking industry. So this basically reflects our expectation that while downside risk to banks' asset quality remains, the impact is manageable and the banking industry has ample headroom to weather the deterioration. Also, we expect the majority of bank ratings to stay intact in the next 12 months. Any rating action will likely be prompted by bank-specific challenges rather than broad industry concerns. Next. Next, Lim. Yep. Overall, loan growth has picked up since fourth quarter last year, given the pent-up demand as well as the gradual reopening of the economy. In May this year, the banking industry loans grew 5% year-on-year. This was driven by both household and business loans, which expanded at around the same pace. That said, risks have tilted to the downside, given rising cost pressures, supply chain disruptions, as well as the persistent issue of foreign labor shortage. The recent rate hikes, as well as our expectation of another 25 basis points increase in the second half, could also dampen growth somewhat. But all in all, we think that growth should not derail from our relatively conservative projection of 4.5 to 5% in 2022. Next. Well, if you look at Islamic financing formed about 38% of the banking system loans as at end May 2022. What we have seen is that over the last 5 years, Islamic financing has contributed more than 70% of the banking system's financing growth. So this is pretty much driven by the Islamic First agenda adopted by a few major banks. So this year, the trend is no different. Islamic banks continue to outpace conventional banks in terms of growth, with a year-on-year growth of 9.4% in May versus 2.5% recorded by the conventional banks. Next. Well, coming back to the overall banking system, this chart highlights the year-on-year growth of the various household subsegments. As you can see, most subsegments grew faster year-on-year in May. So residential mortgages, which has been the main driver of household loans, the growth stayed strong with a growth rate of 6.8%. And given the expiry of the home ownership campaign late last year, demand for home loans could ease as some consumers could have front-loaded their purchases. However, there is also this recent announcement that first-time home buyers will benefit from a 50% stamp duty exemption for properties priced between 500,000 and $1 million, which might lend some support to home buying activities in the coming months. We also see quite a noticeable picked up in credit cards and personal financing growth in May, which I think basically ties in with the overall better consumer sentiment, as well as the strong comeback in consumer spending, as shared by Kai Jack earlier. In May, the growth of auto segment has also improved somewhat. We expect the auto loan growth in the second half to be underpinned by strong outstanding car bookings made earlier, given the sales tax exemption. Next. As for the business segments, the growth was rather uneven across the various subsegments. Wholesale and retail trade, as well as manufacturing, continue to deliver strong growth. However, if you look at construction and the real estate segments, they continue to be subdued and are still showing a contraction in the month of May. For construction, I think even though the activity levels have picked up this year, but like Kai Jack mentioned earlier, the construction work remains far below pre-pandemic level in terms of activity. Meanwhile, the commercial property sector continues to face significant oversupply issues, which has been a problem even prior to the pandemic. Next. So in this section, I think we'd just like to give you a quick sense of how the corporates have performed in first quarter of the year, and also share some of our high-level observations in terms of how these corporates have fared in selected financial metrics. The data that we are using is based on a sample size of more than 700 non-financial corporates listed on Bursa Malaysia. Next. So overall earnings in terms of EBITDA for most corporates in most sectors have shown year-on-year improvement in first quarter. The sharp recovery that you see for the plantation sector is driven by the rally in CPO prices starting sometime in the middle of last year. In first quarter, the average CPO prices were up 55% year-on-year, so it's quite a significant jump. The oil and gas sector is also a beneficiary of stronger commodity prices. The uptrend in the crude oil prices that had started even before the Russia and Ukraine war have helped some of the players register better performances in first quarter. Some of the oil and gas support service providers have reported improved utilization and also charter rates following increased demand for their services. The transportation and logistics service providers have also started strong this year. I believe this is generally in line with the rebound that we see in economic activities. Shipping freight rates have shot up due to severe shortage in containers and vessels. On the other hand, the earnings of construction players saw a dip in first quarter, having suffered from the issues relating to labor shortage as well as high building material prices. So these factors may even push contractors into losses for certain projects, especially for those fixed price contracts that were secured earlier. So just to sum up on this slide, given the more uncertain external environment, we expect that the strong post-pandemic recovery seen in first quarter this year to be that it may be tested in the next few quarters. Next. But in general, I think we take comfort that the corporates are entering this period of macro uncertainty with strong balance sheets and liquidity. So ever since the pandemic started, corporates have, in general, taken aggressive cost-cutting measures and conserved cash by deferring capex and investment. So these have helped to keep gearing at fairly low levels. If you look at the chart on the right, the overall liquidity is still comfortable. The cash to OPEX levels are still higher than the levels that we have seen in 2019. So cash buffers are basically enough to sustain operations for almost 4 months. Next. Now coming back to our discussion on the banking industry and zooming into the asset quality picture, as the PERMULE measures were gradually rolled off in the first half of the year, we saw the system's gross impaired loan ratio inched up to 1.64% as at end May 2022. In terms of the proportion of the loans under relief, based on the latest quarterly results briefing of 8 selected banks, this has dropped sharply to around 8% from 28% seen in December last year. And we do expect defaults to continue to trend up in the coming months. And at the same time, the macro headwinds that we talked about earlier could also affect certain pockets of highly leveraged borrowers. However, the percentage of relief loans has actually come in, I would say, better than our earlier assumption. And we have also seen early encouraging signs of repayment trends coming from the expired relief loans. At the same time, what we notice is that banks continue to remain accommodative in extending additional support to distressed borrowers on a case-to-case basis. So all this could limit the uptick in impaired loans this year. So all things considered, we expect the banking sector gross impaired loan ratio to reach 2.2% by year end, compared to our previous guidance of 2.5%. Next. Now, diving into the asset quality of household loans, the impaired loan ratio for the household segment saw a small increase to 1.1% as at end May. Most of the impairments came from the residential mortgage and personal financing segments. We kind of saw a different trend for the passenger vehicle segment, which posted a drop in impaired loans in May. This could be attributed to the generally faster write-offs of impaired auto loans. Moving on to credit cards and personal loans, I mean, if you look at it, although both are unsecured lending, the borrower profiles are actually quite different. So the lower impaired loan ratio of the credit card segment is reflective of the better customer profile in general, whereby a large portion of cardholders are transactors rather than revolvers. Next. Household account for a significant 59% of the banking system loans. So when it comes to asset quality, I think one of the biggest concerns is always the lower income borrowers. These are essentially those earning less than 3,000 a month. This group of borrowers account for about 11% of household loans and are generally more susceptible to economic shocks. So unsurprisingly, these individuals are also more financially stretched, as seen in their higher leverage ratio, as well as the poorer liquid asset buffer in the left chart. We think that the higher cost of living and increased debt servicing from the rising rates will definitely impinge on the lower income group. But we also note that most of the borrowings taken by the lower income group are actually in the form of auto and personal financing, which are mainly fixed rate loans. We also draw comfort from the fact that the labor market is still healthy and the unemployment rate is still low at 3.9%. Next. Now coming to the asset quality of business loans, the impaired loans from the mining and quarrying sector saw a big jump this year with an impaired loan ratio of 21% as at end May. There are two large corporate defaults from the oil and gas sectors in recent quarters. Although I think for us, it's still not immediately clear if they are entirely classified in the mining and quarrying sector. We also gather that one of the exposures is mainly booked as bonds by banks. But overall, this sector is quite small. It only accounts for about 1% of business loans. Therefore, the impaired loan ratio for business loans remain contained at 2.4% as at end May. Meanwhile, the stress in tourism-related sectors is still there, with further impairments coming from the restaurant and hotel subsegment. While domestic travel activities have picked up strongly this year, the sector has yet to sort of recover back to the pre-pandemic levels. The other one that we would like to highlight is the construction sector. The impaired loan ratio is still low at about 2%, but we are closely monitoring the credit trends given the various industry challenges that we have highlighted earlier. Next. Moving on to the credit costs. Here I would like to highlight that the credit cost computation is based on the average of 8 banks, and it would also include their foreign operations if there are any. So in first quarter this year, the average credit cost dropped to an annualized 18 basis points due to lower management overlays. And to some extent, the ratio is also masked by a large one-off reclassification seen at one bank. Although we expect the impaired loans to gradually creep up, the provisions are not expected to rise in tandem, given the large provisioning buffers that were built up since the pandemic started. For the full year, we are looking at the credit cost ratio of 35 basis points compared to our previous guidance of 40 to 50 basis points. The provisioning level in the system is currently at a historically high level. As at end March 2022, the loan loss coverage, including REC reserve for the 8 banks, stood at 128%. Just to add, I think we also expect banks to tread carefully when it comes to the release of provisions, not until they have a clearer picture on the post-relief repayment trends of borrowers. Therefore, we think that major provisioning write-backs will likely take place only in 2023 for most banks. Next. For net interest margin, the average net interest margins of the 8 banks were flat in first quarter at 2.28%, while the OPR hike or the rising interest rate environment, these are typically positive for margins, but this time around we are only expecting a small improvement. Upside to margins will be limited by the stiffer deposit competition, as well as depositors switching back from lower cost current and savings account deposits back to fixed deposits. Next. Turning to funding, overall total deposits grew 5% in May. If you were to include the unrestricted investment accounts, which have been growing quite rapidly, mainly from a few Islamic banks, the growth would come up to 5.7%. So as interest rates trend up, we expect keener deposit competition and also a quicker pace of normalization for banks' funding profiles. Current and saving accounts deposits will continue to decelerate after growing very strongly at double digits in the last 2 years. Fixed deposits, on the other hand, had started to inch up, and that is basically a reversal of the contraction that we have seen in the last 2 years. Next. I would also like to spend a few moments on the funding profiles of Islamic banks. Given their generally weaker deposit franchise, the financing to customer deposit ratio of Islamic banks have been relatively high compared to the conventional banks, hovering at above 90% in the last 5 years. So on this note, what we have observed is some Islamic banks have tapped into Islamic investment accounts to meet their funding needs. Besides, looking to diversify their funding sources, investment accounts also provide some capital relief to Islamic banks because assets funded by these accounts do not attract any capital charge. In any case, we think that Islamic banks that are part of the larger banking group can rely on funding and liquidity support from the group. Next. Now, capitalization continues to be a key credit positive for the banking sector. As highlighted in this chart, most banks have reported a stronger capital ratio as at end May versus the December 2019 position. So this is notwithstanding, firstly, the impact of unrealized fair value losses to capital, given the uptick in bond yields. And secondly, the restriction to add first quarter profits to regulatory capital. I would also like to add that for our capital computation, we have excluded the uplift from transitional arrangements for a fairer comparison among banks. Quite a number of banks have opted for this transitional arrangement during the pandemic, which is an optional forbearance measure by Bank Negara that had lifted banks' capital ratios. This will start to taper off this year and will be completely phased out in 2024. So even after stripping out this temporary capital benefit, as well as assuming continued unrealized losses from on the bond valuations, we expect banks' capital buffers to stay robust. Next. This is just to briefly touch on the capitalization of Islamic banks. Yeah, generally what we have seen is that Islamic banks tend to have a slightly weaker capitalization compared to conventional banks, which is a result of their sustained strong financing growth over the years. However, as mentioned earlier, of late, some Islamic banks have benefited from capital savings from the increasing pool of customer investment accounts, which has provided some relief to their capitalization. Next. So this brings me to my last slide, just to wrap up my presentation with a couple of key takeaways. So moving into the next few quarters, we expect defaults to trend up because credit risks from the pandemic have yet to fully subside. But overall, we expect any asset quality deterioration to remain manageable. Strong provisioning buffers will also mean that banks are well positioned to deal with the challenges that lie ahead. As far as the profitability is concerned, lower credit costs and a slightly better net interest margin should support profitability in the coming year. Although the subdued trading and investment income, as well as the one-off Cukai Makmur, may offset some of these upside. Banks' capital buffers continue to be sturdy and can cushion any additional provisioning that's unexpected when the credit risks eventually crystallize. Last but not least, we expect banks' liquidity and funding profiles to stay healthy, especially in the context of moderate loan growth. That's the end of my presentation. Thank you for listening. Over to you, Li Ning.